Hey everybody, Smart Silver Stacker here. Hope you're doing well. So the gold price continues to march higher today. Spot gold finished up today at $2,927. That is once again a record all-time high closing price for the gold spot market, and it is just a hair's breadth away from the record intraday all-time high that we put in on Tuesday of 29.42. There's a lot of factors that are driving this bull market in gold right now. There's global instability. There's a lot of uncertainty surrounding trade wars and tariffs right now. And also central banks and institutions continue to accumulate large amounts of physical gold bullion. But there are signs that right now, retail investors are beginning to get squeezed. They're getting priced out of this gold market. The spot price has simply risen too high for many of these retail investors to continue to accumulate physical gold. Now that could end up being a very good thing for silver. In fact, I suspect that the rising gold price and the unaffordability of gold for many retail investors will be the factor to catalyze a major breakout in silver to record all-time high prices. So let's get to it. Buy your gold and silver at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Okay, so we're going to take a look at several news stories today, and if you're interested in taking a bit of a deeper dive into some of these stories, I recommend you check out the link down in the description, which goes to my latest newsletter, the web version of that newsletter, where you can see all of these charts and you'll get links back to the original stories. And also, if you're stacking gold or silver bullion, there are some costly mistakes that you want to avoid. And when you sign up for my free e-newsletter with the link down in the description, you'll receive a free report about avoiding some of the most common mistakes. Now, this is about a 5-page report, only going to take you a few minutes to read it, and I highly recommend it because any of these mistakes that we cover could end up costing you hundreds or possibly even thousands of dollars when you are stacking gold and silver bullion. So I urge you to sign up for the newsletter and read that free report that will be attached as a PDF to your welcome email. Okay, so I mentioned that central banks and institutions continue to accumulate gold. Well, it was just reported that the Chinese central bank accumulated another 0.16 million troy ounces of gold in January. And this is continuing their trend of accumulating hard assets, diversifying their assets and their reserves away from fiat currencies, specifically the US dollar. And China has been buying gold now since November. That followed a 6-month hiatus, but they've really been loading up on this stuff. And it's not just China. Central banks around the world in 2025 are forecast to continue buying record amounts of physical gold. And that is why we are seeing the price of gold explode higher and why it's likely to hit $3,000 in the very near future. But there was another policy shift out of China recently, which could boost demand for physical gold even more. They just changed a rule in China, which allows insurers to invest up to 1% of their assets in gold bullion. And this could unlock as much as $27 billion worth of additional demand for gold. The Chinese government here is recognizing the need for stable alternative investments for their insurers and potentially other institutions moving forward. So it's not just the Chinese central bank, but the Chinese government is encouraging these major institutions within China to begin accumulating gold. And this is going to be an important trend to watch as we continue to see the gold price go higher. Now, institutions like central banks, state-backed institutions within China, they don't necessarily care how high the price of gold goes. They're going to keep buying. But who is getting squeezed here is retail investors. And there are reports that Chinese retail investors specifically are beginning to feel squeezed out of the gold market. Jewelry demand is slowing down as the price of gold skyrockets, and also a strong dollar is making gold purchases around the world for many retail investors just incredibly expensive. Gold is performing well in US dollars. Just look at it in foreign currencies. It's over 4,000 Canadian dollars right now. And the managing director of Hong Kong-based consultant Precious Metals Insights was quoted by Bloomberg as saying, there's an affordability issue. He's talking about gold bullion, and then there's just the general economic malaise and the fact that consumers are not in a position to open their purses or wallets in the way they used to. And I think that we're seeing this in the West as well. Here in the US, it's not just in China. Premiums on physical bullion products for retail investors continue to remain incredibly low. And I think part of it is that retail investors are simply being squeezed by high inflation and economic malaise. They don't have the disposable income to invest in hard assets that they used to. However, if it is the rising price of gold, which is discouraging these Chinese consumers and consumers around the world from getting into physical bullion, that could really be a very positive thing for silver, because as gold becomes too expensive, it's out of the reach of many, then silver becomes increasingly attractive to these investors. When a 1 ounce gold coin is going to run you north of $3,000, then a 1 kilogram bar of silver for under $1,100 starts to look very appealing. Now, another indication of the skyrocketing institutional demand for gold bullion was evidenced by the South Korean Mint, the Korean Minting and Security Printing Corp. They had to suspend their gold bar sales due to supply constraints. They couldn't meet the demand that they were experiencing, so they had to halt sales. Now, this is largely due to the massive influx of physical gold bullion into the United States right now in anticipation of potential tariffs and knock-on effects of trade wars. And again, if the supply of physical bullion is inadequate, then what are investors going to look towards? Well, they will begin looking towards silver because it gives you that same physical, tangible asset without the counterparty risk. Now, it's true, gold and silver, have some differences. In particular, it's a lot more difficult to store silver. But for retail investors, that's generally not a problem. That's more of an issue for the institutional investors. And that's one thing that silver really doesn't have. It doesn't have a lot of this central bank or institutional demand. If we do see a surge in retail demand, that could be the catalyst to boost the silver price up to new record all-time highs, just like gold. Now, silver's already doing pretty well. It's up about 47% year over year. So that's certainly nothing to scoff at. But when you look at the previous highs for silver, silver in 2011 was $50, and even in 1980, silver hit $50. If you adjust that for inflation, that gives you an all-time high for the silver spot price in inflated dollars of $204.16, according to the BLS own CPI inflation calculator. Now, another factor that indicates that silver has a bullish outlook moving forward is the recent price action that we've seen in copper. Copper has broken out decisively from a downtrend that was in effect from May of last year. And copper, being a major industrial metal, shares a lot in common with silver. So a breakout in copper is indicative of future bullish outlooks for silver. And a combination of rising industrial demand along with retail investment could really propel the silver market, which is much smaller than the gold market, by the way, to new highs in relatively short order once that begins taking effect. Now, for those out there who prefer to stick to gold, they don't want to switch to silver, there are always goldbacks. And with the introduction of the new 1/2 goldback denomination, which comes in at a just shockingly fractional 1/2000th of an ounce, this basically ensures that physical gold bullion will never actually be out of reach for the majority of investors. And yes, I am aware that goldbacks do have a premium over the spot price, as do almost all fractional gold products. But, if you want to get the lowdown on goldbacks and why that's not something that really worries me when I stack them, you can check out my other videos on the topic. We talk about the difference between premium and spread and why goldbacks, even though they are priced above the spot price of gold, you do retain the value with those. But think about this, even if the spot price of gold rose to about $10,000, one of these half goldback notes would still only run you about $10. So it'd still be within the realm of possibilities for the vast majority of stackers to get their hands on some physical gold in smaller increments. But bringing this back to silver, what we could be looking at here is basically a perfect storm for silver. There have been physical supply deficits for years in silver. It remains incredibly cheap relative to gold. And much of that is attributable to the fact that institutions are not buying this stuff. But as industrial demand continues to rise and potentially retail investors start getting into the silver market in a big way, we could see the spot price of silver move very quickly. But I'd love to know what you think. Leave me a comment down below to let me know. If you enjoyed this video, then check out the video that's popping up on your screen right now. Don't forget to like, comment, and subscribe. Go sign up for the newsletter, and I will catch you next time. Thanks for watching, everybody. Smart Silver Stacker, out.